Hi everyone, this is Eliana Briseño here at the Council on Foundations. We'll get started in just a few minutes. Thank you. Hi everyone, in 2 minutes we'll start the webinar. Thank you.
Welcome everyone, and thank you for participating in today's webinar. My name is Talia Rivera, and I'm the Director of Private Philanthropy and your moderator for this afternoon. Today's webinar is focused on the minimum distribution requirements and will be presented by Suzanne Friday, our Senior Counsel and Vice President of Legal Affairs. Before I turn it over to Suzanne, I'd like to share a few housekeeping items with you. To access the help desk, you can select Help, the Help option in the toolbar at the top of your GoToWebinar navigation panel. We've allotted about 5 minutes at the end of Suzanne's presentation to answer your questions. If you'd like to submit a question, you can do that by clicking the question box in your control panel. To exit the webinar, click the gray X in the upper right corner of the gray webinar navigation bar. If you are using the telephone to listen to the webinar, please make sure to use a landline to ensure call clarity. And finally, we're recording this webinar, and it will be available on the Council's website. Thank you again for joining us, and now I'll turn it over to Suzanne.
Thanks, Talia, and thank you all for joining us today on the webinar. I thought for sure that if I used a code section in the title, that would get lots of people to sign up, and it looks like it worked. But as the title suggests, this is all about Section 4942 of the Internal Revenue Code, which is the section that provides for the minimum payment or minimum distribution amount for private foundations. So our agenda today, and we have an hour for this, so hopefully we'll get through everything. So we're going to start with the excise tax. As many sections of the Internal Revenue Code do, it starts with a penalty tax. That's where this section starts, and that's where we'll start. Then we'll talk about distributable amounts. We'll do an overview of the calculations with the sample calculation. We'll talk about the time period that you have to satisfy the distribution requirement. We'll cover a little bit about carryovers and then dig into what types of distributions qualify. As I'm sure you all know, not every single thing that you spend your money on would qualify for your minimum distribution requirement. So we're going to talk about which distributions do qualify. And then finally, we wrap up with just a very brief discussion of some of the current proposals that are out there or out here in Washington that might affect Section 4942 and the requirements for distribution. As I have to do with all my webinars, I have to put a little disclaimer up here. I'm not here to provide legal or tax advice, and we always encourage you guys to seek your own legal counsel or tax advisors when you're preparing your 990-PF. So as I said, so many sections in the code start by assessing a penalty tax or some kind of tax, and 4942 is no exception. In fact, it's titled Tax on Failure to Distribute Income. So what this section of the code does, and this is a section that applies only to private foundations. So if you're not a private foundation, you're listening in, that's great. This is good information, but please be aware it only applies to private foundations. And what it does, it imposes a penalty tax on the undistributed income of a private foundation in any taxable year. The initial penalty tax is 30% of the income that remains undistributed after the deadline. There can be an additional tax equal to 100% of that amount if you don't correct the initial tax, don't pay the initial tax and correct the undistributed amount timely. And the idea behind this is that it's designed to encourage private foundations to make distributions for charitable purposes and to prevent those foundations from simply receiving gifts, investing the assets, and never spending any of the money on charitable purposes. So when we talk about undistributed income, we have to talk about the distributable amount. What is the amount you must distribute? And it's very often referred to as the 5% payoff. And 5% is usually a pretty good estimation of what that amount will be, but it's not always exactly 5%. But the distributable amount, according to this code section, is the minimum amount that a private foundation must meet or must distribute to avoid the penalty tax. And again, it's generally something very close to 5% of your investment assets. And the intention of setting that number at 5% was to approximate the income, the investment income that you're earning on your investment assets. So we mentioned income and what your income on your investment assets will be. We have to understand that when we're talking about this type of income, we're looking at income that non-charitable assets are earning. These are your investment assets or your endowment. They are not the assets that you're using for your actual charitable programs or your charitable purposes. These are your investment assets, non-charitable assets, also known as your endowment. And when we look at these assets, the code requires that we aggregate the fair market value of all these assets other than those that are used or held for use directly in carrying out the foundation's exempt purpose. This aggregation is calculated as a 12-month average to allow for investment fluctuation during the year. And you can deduct qualified acquisition indebtedness on those assets. So if you have an investment asset that you've actually incurred debt to acquire, you can deduct the debt on that to get the value of the asset. So again, we said this does not include assets that you're using or holding for your exempt purpose, and examples of these can be the building that houses your foundation if you own the building, your fixtures and furniture and equipment and computers. If you're a private foundation, such as a museum that has an art collection which is used directly for its exempt purpose, those assets would not be counted. Or a library, the books would not be counted. Those are examples of assets that are used for exempt purpose. So we're not counting the value of those things. We're really only looking at your investment assets. I mentioned that this amount is calculated as a 12-month average. So basically, you need to know what the value of your investment assets are each of the 12 months of the year. And you can decide on how you figure that out. You can you can measure it on the first day of the month or the last day of the month, or you can average the first and the last day of the month. But it has to be a reasonable method, and it has to be used consistently. So you figure out how much your investment assets are worth each month, and then you take all the 12 months and add them together and divide by 12, and that is the annual value of your investment assets, and that's the value to which the 5% is going to be applied. So now we get to the calculation. So I said you've got your 12-month average of what your investment assets fair market value are worth in the year in question. You can reduce that value by up to 1.5% for cash on hand. So the IRS recognizes that you might have $1 million in investment assets, but you do need to keep a little safety net. You do need to keep a little bit of those assets available for operations or other needs. So they allow you to deduct right off the top 1.5% for cash on hand. Then you take that remaining amount and multiply it by 5%. So that's why we often refer to this as the 5% payout. But you do get a credit then for excise tax that you pay on your net investment income under IRS or under the code section 4940. And that can be a subject of a completely different webinar, but 4940 does impose a separate tax on your net investment income, which starts at 2% but can be reduced to 1% under certain circumstances. So up on the next slide is just a very simple calculation. We've got a private foundation that has determined their 12-month average of their investment assets to be $1 million. They subtract the 1.5% for cash on hand, and the resulting amount is $985,000. We multiply that by 5%, so the distributable amount is $49,250. They did pay $1,000 in excise tax on their net investment income, so we can give a credit for that, and the remaining distributable amount is $48,250. So for the year in question, this private foundation that has $1 million of investment assets must distribute $48,250 to stay compliant and avoid the penalty tax under 4942. So you might be asking, okay, great, we know how much we have to distribute. How much time do we have to distribute that amount? And the rules provide that private foundations have until the end of the following year to satisfy the minimum payout. And that makes sense if you think about the way these are calculated. You're generally not going to know for sure until the very end of the year, or maybe just after the end of the year, what your 12-month average investment assets are worth. So the code section provides that you have then the following year to make that distribution amount. And interesting result for a brand new foundation is that during their initial year they could really pay nothing because they won't know what their asset value is for the 12-month average, and then the code gives them the whole following year to make those distributions. This section also provides for carryovers. So if in any tax year your foundation is exceeding its minimum payout requirement, meaning that your qualified distributions exceed the distributable amount that you've just calculated, the excess can be carried over to help satisfy future year payouts up to 5 years. So it's possible that if you have a year where you have made quite a lot of distributions and greatly exceeded your distributable amount, the following year you could actually not have to distribute anything. Of course, we don't encourage that, but that's the way the rules work out. So there is a carryover to provide and give a benefit for those foundations that distribute more than they're required to under the code. So I'm going to pause here for a minute and make sure we don't have any questions. I think we're good, because the next section is really important section, and this is where a lot of the questions that I get here at the council come from. Private foundations generally understand their distribution requirement. They generally understand that it's about 5% of their investment assets. But the questions I get are about what types of distributions can satisfy that 5%. And that's the heart of this next section. So basically the key things that will help you satisfy your distribution amounts include grants to unrelated public charities. That's the easy one. You as a private foundation, I'm sure, make grants to other unrelated public charities, and by unrelated I mean they're not related to your private foundation. But additionally, you can count reasonable and necessary administrative expenses toward your distribution amount. You can count amounts that are paid to acquire direct use assets. So for instance, that private foundation that's a museum and acquires a new painting can count the cost of that new painting. You can count grants to unrelated private operating foundations. And we have information on our website if anyone's wondering about the difference between a private operating foundation and a non-operating foundation. But essentially the non-operating foundations are the private foundations that generally make grants to others, while private operating foundations are the foundations that spend the bulk of their time and money engaged in charitable programs. You can also count certain set-asides. So there are provisions in this code section that allow you as a private foundation to hold back or set aside money that you intend to grant in later years for a specific project or goal or some large expenditure that you're anticipating in the future, and you want to set aside money for that purpose. So that is accounted for in this code section, and there's some rules about how you determine whether it's a qualified set-aside, but that's another option that will count toward your distribution amount. And then finally, amounts paid other than grants to accomplish exempt purposes. So we've gotten questions recently about program-related investments. May not necessarily be grants, but a lot of these amounts can also count toward your distribution requirement. Now, I mentioned unrelated organizations. If you are making grants to related organizations and other private non-operating foundations, there is a special rule. Generally, these amounts will not count toward your distribution amount. But if you are wanting to make a grant to another private foundation or to a related organization, it will count toward your distribution amount if your grantee, the recipient of that grant, then re-grants an equivalent amount no later than the end of the tax year after the year it receives it. And adequate records need to be kept to prove this. So the idea behind this is that if you are giving to another private foundation, we want to discourage that private foundation from just holding the money, adding it to its endowment, and not using it, actively using it for charitable purposes. So they've provided this rule that recognizes that where there may be circumstances where you would want to grant to another private foundation, and if that private foundation then quickly uses that amount and spends that out in a grant, say for instance a grant to a public charity, within the time period provided, this before the end of the year, after the year they receive it, then the IRS is going to be okay with that, and they're going to say, okay, you can count that toward your distribution amount because we know it's getting out there and it's not just being held in an endowment. But that's an important rule for private foundation to private foundation granting. I do also want to make a note, and I think we're going to talk about this later in the Washington Update part, but if you're a private foundation and you have a donor advised fund at a public charity such as a community foundation, under the Section 4942 and under the rules, a distribution to that donor advised fund is counted as a grant to a public charity and counts toward your distribution requirement. So even if you're granting to a donor advised fund where you or other members of the foundation may have advisory privilege, under current law, that is acceptable as a qualified distribution and will count to your distribution amount. Question has been raised, though, whether or not, because someone at the private foundation has the advisory privilege, is that control over that donor advised fund, and could that be considered a controlled organization? Currently, the answer is no, but it is something that regulators here in Washington are looking at and are concerned about. And I think on my last slide, I'm going to talk about that a little bit further. Another question we get from time to time is whether grants to supporting organizations will count toward the distribution requirement. And generally, grants to the following will not count as part of your distribution requirement. If it's a Type 3 non-functionally integrated supporting organization, or if it's a Type 1 or 2 and it's controlled directly or indirectly by a disqualified person. So a Type 1 or a Type 2 supporting org that's not controlled by a disqualified person would be an acceptable grantee, and that grant could count toward your distribution amount. But if it's a Type 3 non-functionally integrated supporting org, or if there's some control of the supporting org, that grant will not count toward your distribution amount. And I do want to pause here for just a quick minute to say, just because a grant does not count toward your distribution amount, your 5%, doesn't mean you can't make it. Absolutely, you can still make many of these grants. It's just a question of whether or not they will count toward your 5%. Right now, with the system of rules that we have, private foundations are very attuned to that 5% and meeting that 5% requirement. And so most expenditures are viewed in terms of whether or not they will meet that requirement. But it's not the only consideration when you're making grants, and I'm sure everyone understands that. So if you wanted to make a grant and for one reason or another it would not apply to your distribution amount, you can still make the grant. Just know that it's not going to count toward that amount. So I mentioned a minute ago about granting to organizations that are controlled by disqualified persons. The code, of course, has a nice definition or a laundry list of who are the disqualified persons. And I'm not going to read every one of them, but basically it's going to be your board of directors, your trustees, foundation managers and employees with authority to act on behalf of the foundation, and substantial contributors, your substantial donors. And remember, with private foundations that are corporate foundations, the donor is often the corporation itself, so the corporation can be a disqualified person. We also include family members of the above and business interests that are at least 35% owned by disqualified persons. So that's the list, and I'm sure these slides will be distributed to everyone who's dialed in today later, so don't worry if you don't get this entire list. All right, so I'm going to pause again.
Suzanne?
Because, yeah?
Yeah, I do have a question, and the question is, what is an example of an employee with authority?
Well, certainly, you know, in the private foundation world, it's a little different than your public charities. Public charities, you know, often have large staffs and very, you know, structured staffs and different levels of authority. But certainly your executive directors or your CEOs, and we're talking about paid staff, you know, those paid positions. If the board has hired someone for a paid position and delegated authority to approve grants and take other action on behalf of the foundation, that would be a disqualified person. The board of directors, the entire board of directors or trustees are all disqualified persons. So if your private foundation where your board actually does the work, maybe you don't have other hired employees, but your board is actually doing the work, that's an easy situation because the board is already disqualified because they're members of the board, and you don't have to worry about whether or not they're in their employee role, they're also disqualified. But there certainly could be employees that don't have authority to act on behalf of the foundation. They can't sign contracts or commit to grants on behalf of the foundation. Those persons would not be disqualified persons. So you're not going to have to worry about if someone like that controlled another organization and having that prohibition on grants to those organizations. Oh, can you go back one? Yeah. So we're actually kind of ahead of schedule, which I guess is good because it means we'll have more time for questions, or we'll free up time for your busy days. But the last section of this webinar, I just want to talk about a few things that are going on here in our nation's capital and what lawmakers are thinking about when it comes to private foundations and this payout issue. So unfortunately, lawmakers are hearing from both sides in the debate about the minimum payout levels. They're hearing the payout's not enough, but they're also hearing that the payout is too much. And it's interesting, so there are critics out there, and I'm sure you guys have all seen or heard some of these critics that are not big fans of large endowments and say that there are endowments out there that are too large and not enough money is getting out to the nonprofits and the charities that need it. If anyone follows the news in this area, universities have recently been a target of this. There are universities out there with very large endowments, and critics have said that not enough of their endowment is being spent on charitable programs or student tuition and things like that. In fact, quite a few of the largest universities were surveyed and had to respond to the IRS to a questionnaire with questions about their endowments and how large they were. While in this case universities were the target of this investigation, this kind of thing does affect private foundations that have endowments and other organizations that have endowments. It's not limited to universities. And that's one of the things that the Council keeps a close eye on. Even though we don't have universities as members here at the Council, we know enough to see that when questions are being asked of universities and when their endowments are being questioned, that can have an effect on our members, on the private foundations and the organizations that are members here at the Council. So we pay very close attention to that kind of thing. So there are critics out there that are saying endowments are too big and not enough money is being spent, and they want to increase the minimum distribution amount. But on the other side, we've heard from members in the financial sector that are doing the investment work for the foundations and for the organizations that have these endowments. And they're saying in today's financial climate, investment returns are just not sufficient to support a 5% payout. Because remember, it's not just a 5% grants that you're paying out, but you're also paying other costs and things. So by the time the costs of investing are deducted and other administrative expenses, you may not even have 5% left from your investment income to make grants with. So
yes.
The financial sector is raising a question about whether 5% is the appropriate amount, considering the low investment returns many are getting right now. So
Suzanne, I've definitely heard that concern from some of our members, and one of the things that they said, if they're not earning enough, then what will happen is that they'll end up spending their corpus, and not many foundations are interested in doing that, right? And so you'll have a few more foundations who are spending down their money.
Yeah, and that's a great point, because many of the private foundations, particularly ones that were started years and years ago, from generous donors who set up large endowments, the intent and the donor intent, which we all know is very important, was that these institutions last in perpetuity. So if you're running into a situation where the laws or the distribution requirements are causing you to tap into your principal, the entire idea of perpetuity could be in jeopardy. And I think that's one of the points that I've heard from some financial people, and it's really interesting to hear that you're hearing that as well. And you know what, and on that subject, I do want to just let everybody know that the Council has for 2 years now hosted a summit in New York City, and we will be doing the same thing again in October. It's a summit all about endowments and finance for foundations for our members. I know I went to the one this past October, and it was really well attended, and the speakers were just excellent. We're going to be doing that again in October, so I hope everyone watches our website under the events section. I think, is there information already on it? Not yet. Talia, maybe we'll get information up soon on the Finance and Endowment Summit that we'll have in October. But October 11th through 13th. October 11th through 13th. New York City. Thank you. All right.
Thank you, Suzanne, so much. We really appreciate you taking the time to do this. And if there aren't any more questions, then we're going to give you a half an hour back. And we really do appreciate you being here with us today. And we will see you next time. Thank you.
Thanks, Talia. Thanks, everyone.
Thank you.